Exchange rate definitions and quotation conventions. An exchange rate tells you how many units of one currency you need to buy one unit of another. Think of it like the price tag on a foreign currency product. Spot rate is the price for a transaction that settles in 2 business days. It is the cash price you see on news sites. Forward rate is the agreed-upon price today for a transaction that will settle at a future date, for example 3-month forward. It works like a prepaid ticket. You lock in today's price to avoid future surprise. Direct quote is home currency per foreign unit. In the United States, we quote USD per JPY equals 150, meaning 150 USD to buy 1 JPY. It answers the question, how many dollars do I need for 1 yen? Indirect quote is foreign currency per home unit. In the United Kingdom, you might see GBP per USD equals 1.30, meaning 1.30 USD for 1 pound. It answers how many dollars do I get for 1 pound. The choice of convention is just a matter of habit. The two are reciprocals. For example, 1 divided by 150 equals 0.0067. The forward rate is linked to the spot rate through interest rate differentials, covered interest parity, which we explore later. Real-world analogy. Buying a coffee abroad, the spot rate is the price you pay today. The forward rate is like prepaying for a coffee you will have next month at today's price. Theoretical foundations of exchange rate determination. 2 core ideas help us predict how exchange rates move. Purchasing power parity (PPP). Absolute PPP. Identical goods should cost the same when expressed in a common currency. E equals P star divided by P. Where E is the nominal exchange rate home currency per foreign, P is the domestic price level, and P star is the foreign price level. If US prices rise 5% and Japanese prices stay flat, PPP predicts the dollar will depreciate by about 5% relative to the yen. Relative PPP focuses on inflation rates over time. Delta E over E is approximately pi star minus pi, where pi and pi star are domestic and foreign inflation rates. Example, if US inflation is 2% and Euro area inflation is 1%, the dollar should depreciate by about 1% per year. Interest rate parity (IRP). Covered IRP, no arbitrage with forward contracts. 1 plus I equals 1 plus I star multiplied by F divided by S. Where I and I star are domestic and foreign nominal interest rates, S is the spot rate, F is the forward rate. Rearranged, F divided by S equals 1 plus I divided by 1 plus I star. If US rates are 4% and Euro rates are 2%, the forward dollar should depreciate by roughly 2%. Uncovered IRP expectations, no forward contract. Expected future spot rate minus current spot rate divided by current spot rate is approximately I minus I star, where E sub T plus 1 is the expected future spot rate. Thus, higher domestic rates imply expected depreciation. Both PPP and IRP rest on the law of one price. Identical assets cannot sell for different prices after adjusting for exchange rates. In practice, transportation costs, tariffs, and risk premia cause deviations, but the formulas give a solid baseline for MBA level analysis. Fixed, managed float, and floating regimes. Countries choose how much control they keep over their exchange rate. Fixed or pegged regime. The central bank declares a target parity, for example $1 equals 3.75 Saudi riyal, and defends it. Tools are open market foreign exchange operations, buying or selling reserves, import-export controls, and interest rate adjustments. Outcome exchange rate stability encourages trade and investment, but the country must hold enough foreign reserves to intervene. If reserves run low, the peg becomes vulnerable. Think of Argentina 2001. Managed float or dirty float. The rate is mostly market determined, but the central bank steps in occasionally to smooth excessive volatility. Tools are spot market interventions, occasional verbal guidance, jobbing, and changes in reserve requirements. Outcome provides some stability while retaining monetary policy autonomy. Floating or free float. The rate is left to supply-demand dynamics in the foreign exchange market. Tools, virtually none. The central bank may intervene only in emergencies. Outcome exchange rate absorbs shocks, allowing independent monetary policy. However, businesses face higher exchange rate risk. Analogy: imagine a thermostat, the exchange rate. A fixed regime is like setting the thermostat to a constant temperature and using the heater or cooler constantly to keep it there. A managed float lets the temperature drift a bit but turns the heater on if it goes too low or high. A floating regime just lets the room temperature follow the weather. Parity adjustments. In a fixed system, a misalignment, overvaluation leads to a loss of competitiveness and a current account deficit. To restore parity, the central bank may devalue, raise the quoted price of foreign currency, or let the peg collapse. Balance of payments structure and identities. The balance of payments, BOP, records all economic transactions between residents and non-residents in a given period. It has three major accounts that must, by accounting identity, sum to zero, ignoring statistical errors. Current account, CA, trade in goods and services, primary income profits wages, and secondary income remittances aid. CA equals X minus M plus NIT plus NCT. Where X equals exports, M equals imports, NIT equals net income from abroad, and CT equals net current transfers. Capital account, KA, transfers of non-produced, non-financial assets, for example debt forgiveness, migrants' assets, often small. Financial account, FA, transactions in financial assets, direct investment, portfolio investment, other investment, and reserve assets. FA equals delta D sub D I plus delta D sub P, I plus delta D sub O I plus delta R. Where delta D denotes change in holdings, and delta R is change in official reserves. Overall identities. CA plus KA plus FA equals 0. Or CA plus KA plus FA plus delta R equals 0 if reserves are kept separate. If the current account is in deficit negative, the financial account must be in surplus positive or the country must draw down reserves. Real-world example: the United States runs a persistent C, a deficit imports greater than exports. This deficit is financed by a large FA surplus, foreign investors buy U.S. Treasury bonds, corporate equity, etc. The U.S. also builds up net foreign asset liabilities. Official reserves are the foreign exchange holdings of the central bank, for example dollars, euros, gold. They act as a buffer. An increase in reserves appears as a credit in the financial account, central bank buying foreign currency. Exchange rate BOP interaction. The link between the exchange rate and the current account is captured by the Marshall-Lerner condition. It says that a depreciation of the domestic currency will improve the trade balance if and only if the sum of the export price elasticity epsilon sub x and the import price elasticity epsilon sub m exceeds 1. Partial C A over partial E greater than 0, if and only if epsilon sub x plus epsilon sub m greater than 1, where E is the nominal exchange rate home per foreign. Why? Depreciation makes exports cheaper abroad raising X and imports more expensive domestically reducing M. The magnitude of response depends on how sensitive quantities are to price changes, the elasticities. Formulaic example. Export quantity response. Delta X over X equals negative epsilon sub X times delta E over E. Import quantity response. Delta M over M equals epsilon sub M times delta E over E. If epsilon sub X equals 0.4 and epsilon sub M equals 0.7, the sum equals 1.1 greater than 1, so a 10% depreciation improves the trade balance. Balance of payments adjustments. When a country faces a CA deficit, the pressure is on the financial account and/or reserves. A depreciation or devaluation can be used deliberately policy devaluation to restore equilibrium. The speed of adjustment depends on price elasticities, capital mobility, and expectations of future rates via IRP. BOP crises and exchange rate dynamics. A balance of payments crisis occurs when a country cannot meet its external obligations, usually because reserves are exhausted, and the current account deficit is large. Typical steps. Persistent C, a deficit leads to outflow of capital, leading to reserve depletion. Market fears a devaluation, leading to speculative attack, selling domestic currency for foreign reserves. Central bank runs out of reserves, leading to forced devaluation or abandonment of peg. A country can only achieve two of the following three simultaneously: fixed exchange rate, Independent monetary policy, free capital mobility. If you keep a fixed peg and allow capital to flow freely, you lose control over domestic interest rates. They must align with foreign rates to maintain the peg. Numeric illustration. Assume a peg, $1 equals 5 local currency. Domestic interest rate I equals 6%, foreign rate I star equals 2%. According to uncovered IRP, expected depreciation equals I minus I star equals 4%. Market expects the local currency to lose 4% per year. That is, the peg is unsustainable. Speculators sell local currency for US dollars. Central bank uses reserves to buy back local currency. After losing 50% of reserves, the bank abandons the peg. Local currency depreciates to 6 local currency per US dollar, 20% devaluation. Crisis resolution mechanisms. IMF programs provide emergency financing, conditioned on fiscal consolidation and structural reforms. Capital controls temporarily limit outflows. Currency board ties the domestic currency strictly to a foreign anchor with 100% reserve backing. Debt restructuring negotiates with creditors to ease repayment pressure. The Mundell-Fleming framework extends the IS-LM model to an open economy. It uses 3 curves. IS, goods market equilibrium, Y equals C of Y minus T, plus I of I plus G plus N X of E. LM, money market equilibrium, M over P equals L of I comma Y. BP or BOP curve, balance of payments equilibrium. Under perfect capital mobility, BP is horizontal at the world interest rate I star. Under imperfect mobility, BP is upward sloping. BP, I equals I star plus beta E, where beta measures sensitivity of capital flows to the exchange rate. Key results: fixed versus floating. Fixed exchange rate, perfect capital mobility, monetary policy is ineffective. An expansionary monetary shock shifts LM right, but the resulting lower I triggers capital outflow, forcing the central bank to sell foreign reserves and offset the LM shift. Fiscal policy is powerful because a higher G shifts IS right, raising I above I star, leading to capital inflow, leading to upward pressure on reserves, forcing the peg to appreciate, which is prevented, so the effect fully translates into higher Y. Floating exchange rate, perfect capital mobility, monetary policy is effective. An expansionary monetary shock shifts LM right, lowering I below I star, leading to capital outflow, leading to depreciation, E rises, leading to net exports rise, shifting IS right, leading to higher Y. Fiscal policy is less effective because an expansionary fiscal shift raises I above I star, leading to capital inflow, leading to appreciation, leading to net exports fall, offsetting part of the fiscal boost. Algebraic solution example, floating rate. Assume linear forms IS, Y equals a minus BI plus CE. LM I equals D minus EY. BP I equals I star plus beta E. Solve for Y and E after a monetary increase delta M that lowers D to D minus delta D. Substituting LM into BP gives D minus delta D minus EY equals I star plus beta E, leading to Y equals open parenthesis D minus delta D minus I star minus beta E close parenthesis divided by. Plug into IS and solve simultaneously, details omitted for brevity. The result shows Y rises and E, domestic currency per foreign, falls, depreciation. The MF model thus links policy choices, exchange rate movement, and balance of payments outcomes in a clear, algebraic way. Exchange rate calculation, purchasing power parity. United States Consumer Price Index equals 120, Euro Area Consumer Price Index equals 110. Current Euro/US dollar spot equals $1.2 per euro. What should the spot be after 1 year if only inflation changes? Solution: relative purchasing power parity. Delta E over E equals pi US minus pi EU equals open parenthesis 120 minus 100 close parenthesis divided by 100 minus open parenthesis 110 minus 100 close parenthesis divided by 100 equals 0.2 minus 0.1 equals 0.1. Expected depreciation of the US dollar equals 10%. New rate equals 1.2 times open parenthesis 1 plus 0.1 close parenthesis equals $1.32 per euro. Interest rate parity covered. Spot euro/US dollar equals 1.1. United States interest rate equals 4%, euro area interest rate equals 2%. Find the 6-month forward rate. Solution: forward rate equals spot times open parenthesis 1 plus I US close parenthesis divided by open parenthesis 1 plus I euro close parenthesis. That is 1.1 times open parenthesis 1.04 close parenthesis divided by open parenthesis 1.02 close parenthesis equals 1.1 times 1.0196 equals 1.1216. Marshall-Lerner check. Export price elasticity equals 0.3, import price elasticity equals 0.8. If the domestic currency depreciates by 15%, will the trade balance improve? Sum equals 0.3 plus 0.8 equals 1.1, which is greater than 1. Condition satisfied, therefore the trade balance improves. Balance of payments identity. A country reports, current account equals negative $30 billion, capital account equals $2 billion, change in official reserves equals negative $5 billion. What is the financial account balance? Solution: financial account equals negative open parenthesis current account plus capital account plus delta reserves close parenthesis. That is negative open parenthesis negative 30 plus 2 minus 5 close parenthesis equals negative open parenthesis negative 33 close parenthesis equals $33 billion surplus. Mundell-Fleming model floating exchange rate with perfect capital mobility. Initial equilibrium, output equals 500, interest rate equals star equals 5%, exchange rate equals 1.0. Government increases spending by $50 billion, shifting the IS curve right by 0.5 y per unit of government spending. What is the new output assuming the exchange rate adjusts to keep interest rate equal to the world rate? Solution: change in output equals D times delta G equals 0.5 times 50 equals 25 units of output. However, with perfect capital mobility, the fiscal expansion causes an appreciation